Have you ever been presented a whole life insurance policy and think, this looks horrible. Why would I put money here? You don't move forward, but then a year goes by, maybe it's 3 or 4 years, maybe it's 10 years, and then you see it presented in a different fashion and you think, why was I not shown this before? I would have moved forward if someone would have shown me these type of options. Happens quite a bit in the industry. You know, a number of years ago, an individual called our office, and it was when our office was very small. We had a number of part-time assistants and one agent that to this day, I still can't believe that she just decided to work with us because we didn't really have a company. It was me saying, yeah, it's great, come on in. And her nickname today is number 1 because she's one of the top agents here. But she begins working with this individual, and I helped her out because she was learning at the time as well. But an individual called our office, and he had looked at whole life insurance before, about 4 years ago, and he didn't move forward with it. Now, what had intrigued him, what had sparked his interest around a high cash value life insurance policy was the idea of the banking concept. He spoke with a number of agents. He was really interested in putting his money into a cash value life insurance policy because he saw that it would continue to compound and he would not have to rely on banks anymore. Instead of going to a bank for financing and lending, he could borrow from his policy, which he heavily invests in property, business. He's got a lot going on. Him and his wife are very successful with what they do on their career paths, but they also have a lot going on the side. So they love the idea of putting money in this cash value life insurance, safe, liquid, tax-free, but they were presented it and said, I'm not doing this. They're looking at 100 grand going in, and they see next to nothing in cash value in the beginning. Then they see an option that has 60% cash value relative to what they paid, and he's still like, there's too much of a lost opportunity cost here. How I grow my business is by taking capital I have here. I should say how I grow my net worth is by taking capital I have and putting that into my business, into my real estate deals. That's how I constantly grow it. So now I'm being pitched on this concept, which I love, but to take this huge hit on my money, like I can't do it. It's not going to work. So the concept sounded great, but the numbers looked awful. 4 years later, he stumbles across some of our content when we weren't even marketing. I had some webinars out there that I started doing, and we put them on YouTube, and he saw one of them with rich cash values, taking loans, repaying them, how it worked, all that fun stuff, and he calls up the office. And he said, okay, just to get to the point, I like these options. I can do everything that I wanted to do before. How come I wasn't shown this before? He just straight up asks, is it the commission? Like, what's going on? Yeah, it was. And we just went into details as far as how compensation works and full transparency. We've got plenty of those videos on commission on our channel. But what he saw was more money up front and also long term. So he wanted to practice the banking concept, but why he did not move forward is there wasn't enough cash value based on his goals and what he wanted to accomplish. So what he was originally presented, we're going to look at what he saw and what he did not move forward with, and then what he did see and said, okay, this works for me, here's what I want to do. So on the left, we see a 40-60 split. What that means is he's got $100,000 going into the policy, of which the premium is $40,000. Premium dollars with a traditional product like this do not show up in cash value in the first and second year. Here's why I mention this. 100 grand goes into a policy. Here's cash value that he has access to. $64,000 right off the bat. Is that a good place to put money? If I have a real estate deal that I want to put 100 grand down or 80 grand down, if I put it here first, I don't have the money because $40,000 was directed toward my insurance premium, which generated a commission and primarily purchased me a death benefit. I have a negative $35,000, almost $36,000 hit. Like, doesn't make sense. The second year pays in the same $100,000. The funding is up until age 60 in this example. Total of $200K, he's got $132 in. His cash value grew from 64 to 132. That means of the 100 he paid in, $32,000 did not show up in cash value. He got about $68,000 back of that $100K payment in the second year. That's 2 years. If you tally those numbers up, you're getting close to $70,000 lost, and now you've got an opportunity cost issue. I want to touch on something here. Every entrepreneur and business owner that does very, very well that I've spoken with values the opportunity cost more than anything else. They like whole life insurance designed for high cash value as a means to position their money that they can access whenever they want for opportunities, great alternative to a bank account in that respect. What they do not like, and why the successful entrepreneurs I've met do not move forward with it, the objections, is this. They're like, I'm not taking that hit up front. There's a couple that I really, really like. They do about 85 million per year in revenue. And I remember talking to the couple, the wife said something, she made me laugh when she said it. She goes, yeah, we were presented on this before, but we're looking at the values, didn't make sense. Fortunately, my husband can do math, and he looked at it and said, there's no way. And he said, it's the opportunity cost. Like, I don't care what it looks like long term, it's a great alternative to my bank account, but it has to make sense. Same thing happened here. That's what occurs all the time when we look at the value. In this case, it takes him 8 years just to recapture his payments. That's a long time. And then we see it grow over time, but still, that's what he was presented, didn't move forward with it. However, down the road, here's an alternative we see. What do we see here? Same 100,000 going in. This is the same company, same product, same individual, 100 grand in, almost 88% right off the bat. World of difference. Now you still have a negative hit in the first year. The premium in this example is $10,000. So by reducing the premium, you do reduce the compensation. You allow more money to go towards cash value, which is in the consumer's best interest because that's what they want. If you're not interested in a high cash value life insurance policy, it's a different story. But what do we see? Time passes, breaking even, year 5. Here's your cash value growth year over year. You get more back than what you pay in year 3. What happened in year 3 in the last example? Get less back than what you pay in. So up front is when you're going to see the biggest hit with a high base premium compared to a low base premium. Now as time passes, let's see what happens. Wanted to fund for 20 years. What do we notice at year 20? Cash value with the 40/60, 2.918. Cash value with a 1090, 2.978. This, I'm going to circle this in purple because it is purple, is the cash value difference. 1090 has about 60 grand more by year 20. More from start to finish. Now I want to touch on a point that can be a bit technical. In black is our cash value growth. What this means is year 20, the cash value, the net growth, not counting what you paid in, grew by $130,000 in the 40/60 and $120,000 in the 1090. Now, we've seen, and some people have brought this up to us, that a 40/60 makes more sense because you're growing at a faster rate by year 20. And I heard that, I'm like, that doesn't make more sense. That's one of the more foolish things I've ever heard. We hear that it's more efficient over time. Well, I don't care if I've got a stronger finishing kick in the race. I ran track and field. That's why I use that example. Like, I can have a fast finishing kick, but if someone else already crossed the finish line, like, I've got more money. At the end of the day, I've got more from start to finish, which gives me more buying power, more capital, a greater death benefit. And as time passes, that 1090 just continues to outpace. We've got a greater monetary value. You can tell from the purple column. And on the 40/60, if we want to make another payment of $100,000, it would make, one thing I neglected to mention, the 40/60 does not have a term rider, whereas the 1090 does. A nice, big 1-year term rider that performs fantastic over time, guaranteed and non-guaranteed. So my point here, this individual was very, very attracted to the idea of the concept. However, he values his money. Like the cash value, he's looking at it and says, this is what I want to do. I want to make sure I have the value maximized from start to finish, and do what banks, corporations, the wealthy, everything I hear about them doing. Here's how to do it. Minimize expenses, maximize cash value. So, hope you enjoyed this one. If you have any questions, please feel free to reach out anytime. If you did enjoy, please hit the like button, subscribe for more, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.